I'm Taylor Riggs in for Emily Chang. This is the best of Bloomberg Technology, where we bring you all of our top interviews from this week in tech. Coming up, Oracle's CEO takes leave. Mark Hurd announces he will take a leave of absence for health reasons. We'll discuss what it means for the company. Plus, cooking it up, Apple CEO Tim Cook takes the stage in Cupertino Tuesday. His deputies reveal the new iPhone 11 models with new colors and 3 cameras. Details on those devices and more, like the Apple Watch Series 5. And linking up, we get an exclusive check-in with LinkedIn CEO Jeff Weiner. His thoughts on the company 3 years after Microsoft acquired the job listing site. We begin with one of our top stories this week. Oracle announced Wednesday that CEO Mark Hurd is taking a leave of absence for health reasons. The software company disclosed the move along with quarterly earnings a day earlier than results were scheduled to be released. The company did not specify what issues Hurd faces or how long his leave will be, but Executive Chairman Larry Ellison released a statement saying, quote, Oracle has an extremely capable CEO in Safra Catz and an extraordinarily deep team of executives, many with long tenure at Oracle. Safra and I will cover Mark's responsibilities during his absence with support from the rest of our strong management team. To discuss, I spoke with Bloomberg Intelligence senior analyst Anurag Rana in New York and global executive editor Tom Giles.
As far as his leave, so there have been signs over the last year that he may not be unwell. What was not expected was the announcement to come today. So, and because they hadn't announced it up until now, there was a question mark about whether they would and whether he was getting well or not. So it took us a little bit by surprise, the timing in particular.
Anurag, I want to bring you in here. You heard it from Larry's mouth. He said that he and Safra will take over. Does any of this change the future direction of the company?
No, it doesn't change the future direction of the company. Oracle is a very stable business from, given the large on-premise database business that they have and a very large applications business. The key risk for Oracle, or the key story for Oracle, remains how soon can they get their database customers onto the cloud. That story still remains the same. I don't see any changes because of this shift.
Tom, Mark Hurd really was known as working on shifting that composition from hardware to software. He touted getting to 50% software. How did he do? Yeah,
well, so it's been a mixed record for Oracle over the last several years. Now, their stock price, I should note, has been really over 20% gain this year because a lot of investors are looking at that staff, that deep bench. They're looking at the shift, and they're starting to see signs that it's taking root. It hasn't been even. There have been quarters where people have really doubted. Today's numbers, again, which we'll talk about in a minute, looking a little light. So it hasn't been super even. However, what you are seeing is when customers do shift to the cloud, that is where the growth is really coming from. The legacy database business, traditional software, has not been growing as needed. And has the shift been happening as quickly as people wanted? Sometimes the answer has been no. But again, when you look at that stock price, you're seeing an investor base giving them the benefit of the doubt.
Anurag, talk to me about the earnings. Top line, a little bit of a miss. Margins generally look healthy. What was your takeaway?
Generally an inline quarter with almost everything. There was slight slowdown in the application business, but at the same time we saw margins expanding, we saw buybacks. Overall, I wasn't that surprised with any of the numbers so far. The key issue remains how soon some of the new database products adoption goes, and that we'll see from the call as to how that's going along.
Tom, what does a $15 billion buyback tell you? They've nowhere else to invest, or they actually think their shares are undervalued?
I think it's a little bit of both. Are there acquisitions that you can make? Are there large size acquisitions that you can make? Oracle over the years has been a big acquirer, and they have made some big acquisitions. It seems to me that there's not a lot in the pipeline right now that they want to take aim at, but they have a lot of cash, so I wouldn't rule it out. $15 billion shows a vote of confidence that they have in their stock. When you're announcing that a CEO is taking a leave of absence, again, you want there to be some vote of confidence on the part of the management. And as Larry said in his statement, they have a lot of confidence in their bench. Safra Catz, very capable, very, very well regarded. And Larry, even though he handed over the reins, has never really strayed that far from having a hand in how the company is managed.
Anurag, did the cloud services revenue meet your expectations?
There was, as I said, there was slight slowdown in the applications area, but overall it's lumpy because unlike an Adobe or an Office 365, these large enterprise deals for somebody like an Oracle, could take time. As I said, nothing surprising from our side. Generally inline quarter for us.
Tom, generally speaking, how is Oracle set up among China and tariffs? It's something we talk so often about within the tech sector. What's your broad take?
Right now, I mean, a lot of companies in the tech sector are going to be affected by the tariffs. A lot of it has to do in areas such as hardware. Oracle has not been one of the companies that we've looked at and said, this is going to be a huge hit for them. We talk about Apple a lot. We talk about some of the other companies, some of the chip makers, for example. Oracle, less so. That hasn't been a big area of overhang. I'd be curious to hear what Anurag says about that. But really, the tariff issue is one that we think is going to hit a lot of the other big tech players aside from Oracle.
So Anurag, was the revenue miss not related to tariffs?
No, I don't think so. But as to Tom's comments, enterprise software spending has very little exposure to China, unlike consumer products. But what happens is when you have shocks like China or when you have macro shocks, people pull back spending, enterprise tech spending. You really don't need to upgrade if you don't have to, because you can go around another 6 months before getting that new server or upgrading to the new set of software. And that's where we have already started to see some kind of cracks in the software growth story with some of the companies such as Autodesk talking about some weaknesses in Europe right now that is leading to enterprises spending less on software.
So Anurag, we know that all the glitz and the glam is in software. Get us back to basics. How's the hardware business doing?
Hardware business for, a lot of vendors has been weak, and that has been the story for a while because people have been delaying their hardware upgrade cycles just largely because whatever little money that they have, they want to spend it on the next digital transformation, which means you want to spend it on either advanced security products or you want to spend it on cloud products. So people take money from hardware and they're spending more on software.
Tom, key takeaway from the earnings call that you'll be listening to, all about the CEO?
A lot about the CEO. Why didn't they disclose it sooner than they did? There might be questions along those lines. Who will be in charge of what set of responsibilities that Mark was in charge of? How concerned are they about his health? How long will he be away? And certainly, cloud. That's something that it always comes back to. And as Anurag was pointing out, as people move more and more to the cloud, that's also something that affects spending on hardware, which has not been a real strength business for them.
Anurag, number one talking point from the call that you want to hear?
We want to see what what's the transition or what's the take rate for their new database product. That's a very important thing for us because that's what really dictates how soon people will adopt to the cloud. And any new applications business bookings numbers, those would be the two areas that we'd be looking at.
That was Bloomberg's Anurag Rana and Tom Giles. I also discussed Oracle's executive shakeup with JC2 Venture CEO and founder and former Cisco CEO John Chambers. He weighed in shortly after the announcement.
Well, my reaction first and most important is for, as Larry Ellison said, a speedy recovery for Mark. I think he's in my thoughts and prayers. And if you really think about the team of Larry Ellison, Safra Catz, Mark Hurd, they worked more effectively than almost anybody envisioned that a threesome would work. But Larry and Safra have worked together for, 25 years. And I know all three of them very, very well. Safra is world-class, off the chart. parts. Larry has always been involved in the strategy, the vision, the engineering side of the house, and I think they'll navigate through this one. I don't think they'll have any major issues at all. They've got a deep company, a lot of capabilities, and as I said, Larry and Safra are world-class leaders that are very actively involved, and my thoughts are with Mark for a speedy recovery.
Yeah, John, talk to me more about your relationship with Mark Hurd during Cisco and then his time at Oracle. How was that relationship?
Well, the relationships with Oracle and HP have always been very strong for me. I have a lot of confidence in HP. They helped me when I first moved out to Silicon Valley understand the Valley when I only had 400 people at Cisco, and people got us confused with a food truck company. And Lou Platt there helped a great deal. Their new CEO, Antonio, is amazingly good, and I have a lot of confidence in the direction of HP, and Meg did a nice job on the turnaround. In terms of Safra and Larry, I've always been very, very close to them, both on political issues in terms of positioning tech for good in the world, and they're very, very strong leaders. I would always bet on Larry and Safra and Mark together, and I'd bet on Larry and Safra in the interim, and they've got a deep team. So as an investor, I think they'll navigate through this one very well.
That was JC2 Ventures CEO and founder John Chambers. Coming up, WeWork's IPO woes, why the company is looking to make changes at the top, but will it be enough to save its IPO as investors seem worried? We'll discuss next. And later, watching your health, why Apple is betting its wearables will help transform the health industry. That plus highlights from that big Apple event day in Cupertino Tuesday coming up. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Taylor Riggs. This week brought a flurry of activity from the technology IPO front, including Cloudflare pricing, WeWork IPO woes, and Peloton's rocket ship from a bootstrap company to plans for a public debut. To break down the technology IPO landscape, I asked Bloomberg's Sonali Basak Thursday how Wall Street was interpreting the IPO parade.
Truly amazing. We've been reporting for a couple days that they boosted the price range from 12 to 14. The question is, where now will it price? Obviously, just 2 days ago, we had a lot more optimistic sentiment around some of these big IPOs. A lot of these big IPOs that upped their pricing actually did very well this year. Everybody but Uber and Lyft, really, and WeWork, it's also tumultuous. However, those were considered one-offs in this market that really was valuing growth.
Talk to me about Peloton, which seems to be another fairly big success story. They're out on their roadshow. What's the tone with Peloton?
Well, the tone with Peloton is kind of similar to everybody else. Remember, like we were saying 2 days ago, everything was okay. Today, remember when Smile Direct Club was going to market, they were up. The NASDAQ was up. And so for them to fall so much really has cast a cloud over a lot of these listings that are about to happen, because what's really happening is investors want to see a stronger bottom line. Revenue growth is not enough for a lot of these companies, and we've had the head of investment banking, CEOs of investment banks coming out saying so, which for the first time all year is something we're hearing.
Sonali, what changed?
So for one thing, investor sentiment, we have a lot of people who all of a sudden are saying they want to invest in stocks that are big and steady, value stocks instead of these growth stocks. So remember also there's the WeWork cloud that's over everything now as well, and people are looking for not only companies that are showing a stronger revenue growth, a stronger bottom line, but also governance that they're comfortable with as well. The thing is, if we're at the late stages of an economic cycle and people are worried about the overall environment, people are starting to, at some point, get more cautious as well on what they're investing in.
Well, when we talk about cautious, you earlier were talking about how the NASDAQ was higher. We did see, of course, today another IPO, Smile Direct Club. How did they end up doing?
They ended up down quite a bit, more than 25%, which is something we haven't seen since 2008. We haven't seen since 2008 a company that priced above its range and then went to market and dropped in the first day of trading. Obviously, we saw Uber drop in its first day of trading, but again, Uber priced at the lower end of its range. So you were asking about about Cloudflare. We're waiting for Cloudflare's pricing tonight. Whether or not it prices in this range that they've already increased doesn't indicate whether they will trade well tomorrow, which is something I think is scary for investors.
Well, and another thing, Shonali, that is scary for investors is all about WeWork. Yes. What happened?
So we are really waiting here to see if they're going to kick off this roadshow come Monday. Remember, Bloomberg has been reporting all week that the valuation could be as low as $15 billion. To put that into perspective, Taylor, earlier this year, Goldman Sachs was thinking it could be worth $65 billion, which of course is a little over the $47 billion that they had fetched in valuation earlier this year. And so we're watching valuation just go way down. We're in a situation, according to our sources, where SoftBank is considering more private capital injected into this firm to help turn it around in a place where it can go public in a way that would be more pleasing to investors. But all of that is still up in the air, and it's yet to be seen how they're going to get this IPO done.
Well, Shonali, there was also news that WeWork is considering a slew of changes, including removing the founder's wife from their succession plan. Is that enough?
We will see. Remember, they still have the voting shares that Adam Neumann has, which gives him 20 times more power than all the other investors. Depending on how they change their corporate governance, I think is going to be a really big deal for how investors view the stock. You know, if SoftBank does end up taking a bigger stake in the firm, what interests me here is they already have a bigger stake than Neumann. So who controls this company, SoftBank or Adam Neumann? And so, you know, the wife stepping back from succession planning is one thing, but there's a lot of other corporate governance challenges here that they're facing, and they're trying to clear up before an IPO.
Shonali, just finally, as you take a look at the landscape of the IPOs, who's to blame? Is this the banker's fault, the company's lack of profitability fault, the market's fault?
You know, it's from where I sit, and I'm an investment banking reporter, people like to blame the bankers very quickly for pricing an IPO perhaps too high, right? And normally in an IPO, institutional investors like the pop. Venture capitalists really like for it to be stable. But this market's a tough one. All year, again, like I was saying, these IPOs traded very well. They traded up. But now we're in a situation where all of a sudden, it's like in the blink of an eye, it's just not working for them anymore.
That was Bloomberg's Shonali Bossack. Coming up, delivery game on. Luxury e-commerce platform Vera is ramping up its competition with Amazon by shaving a day off its free delivery service. We'll hear from CEO Imran Khan next. And if you like Bloomberg News, check us out on the radio. You can listen to us on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Is 2-day free shipping speedy enough for the average consumer? Vera doesn't think so. That's why the company announced its new free 1-day shipping Monday for all purchases on its platform. Vera is even going one step further, allowing all customers to benefit from this offer without a membership fee, subscription, or minimum purchase. But is it enough to compete with e-commerce giant Amazon? To discuss, I spoke with Vera CEO Imran Khan. He is also the former chief strategy officer at Snapchat maker Snap.
In our company, we believe customer first, employee second, and shareholder third. And we are maniacally focused on how can we make our customer life better. And we launched our services with 2-day free shipping, and we saw the positivity from our customers. And we wanted to make things better. And that's why we launched free 1-day shipping. So it will get to you in 1-day business day, or we ship to you.
So you say customers before shareholders. How are shareholders responding to the increased cost that this will cost the company?
Yeah, I think, if your customers are happy, they will keep coming back to you. They will become very loyal customers to you, and that will drive significant lifetime value of our customers. And the way we are orienting our company, we're a very young company. We are less than 1 year old. But the way we are orienting the company and the way we are getting everybody focused on, it's the long term. And how should we think about the long-term value of our customers? And we believe by delivering happiness to customers on a daily basis, by delivering the product faster, having the best selection, having the best quality, and having the best customer support. Like, for example, we put our customer support phone number on the top of the site. By doing so, we will be able to increase the lifetime value of our customers, and that's where we really focus on that. And if we do that, that will create long-term shareholder value for the business.
Imran, Amazon and Walmart also have come out recently with free one-day shipping. How do you compete?
Yeah, I think first of all, I think we have to recognize that e-commerce is a very, very large market. If you look at the retail sales in the US is around $5 trillion. Only 10% of is that online. So retail by far is one of the biggest market opportunity out there, and online penetration is still pretty low. So we don't think it's a zero-sum game. We think there will be multiple players who will serve the customers, and we are really focused on how can we serve our customers better. We are focusing on categories like man and women fashion, home, beauty. We recently launched kitchen, and we are just really focused on how can we service our customers better, and we believe the market is big enough to multiple players to do well.
That was Vera Shop CEO Imran Khan. From competitive shopping to competitive gaming, there are more than 2.6 billion gamers in the world, and most consider themselves competitive gamers. That's given rise to esports companies and competitions. In fact, Intel just announced another big esports tournament in Tokyo around the 2020 Olympics. For more on the technology, opportunities, and landscape, I talked to player Ann Hand, CEO of Super League Gaming, Thursday.
When you're entering a brand new market space, very nascent, don't even really know how to define the edges of the pie of how big commercially this market space can be. Many investors see it as a fad until they have children or grandchildren that game. And then they kind of the light bulb goes off. They realize that gaming isn't something you grow out of anymore, that they're spending just as much time watching other people video game as they are game playing themselves, and that this is now something that's even becoming increasingly multi-generational. Now with that, I will say, we're very uniquely positioned as the rare pure esports play listed on NASDAQ. Most, though, of the esports activity you're seeing are really private investments. They do have high valuations. And so with all of those things, when it is an early stage space, often people think and worry about a bubble. What I would tell you is this. Right now, the projections for esports is that it's going to be a $3 billion global market in 2023. I used to run a $3 billion business for BP 10 years ago, and I would not get out of bed if that was just what this was worth. So I think it really just goes back to gaming is how people want to spend their time now as a primary entertainment interest, and we're just figuring out how big the category can be.
Well, you IPO'd just about 6 months ago. How has it been being a public company?
Yeah, it's a funny thing. I really believed that I would wake up every morning in LA at 6 a.m. and stare at my stock price all day. And I'm delighted to say I don't do that. And I am fortunate that I have a lot of really supportive, long-holding investors who are excited about our delivery and kind of tell me, don't look at the stock price day to day, just deliver what you said. That said, it is a strange thing that happened. We have a pretty experienced leadership team, top talent from game publishers like Take-Two, Endeavor, former WME IMG. And what happened is we were a bunch of grown-ups who all of a sudden got a big jolt of adrenaline the day we went public, because it is extremely focusing. And with all that transparency of being public, it also feels hugely empowering. So we often say, we sit around the table now and we talk about opportunities that I don't even think we would have dreamt of when we were sitting there in the small private owned space. So you've got a lot of adults who are taking it seriously, that our credibility is on the line. We know there's a lot of money to be made in esports, and we're determined for Super League to be the leaders in proving it.
That was Super League Gaming CEO Ann Hand. Coming up, you better believe that Bloomberg Technology was all over Apple's new products and services event Tuesday. From new iPhone models to Apple Watch to services like the subscription plan for Apple TV Plus, we have got you covered. That's next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Taylor Riggs. It was a big week for Apple as tech giant launched its newest hardware at its annual product launch Tuesday in Cupertino, California. Among the items unveiled, a new Apple Watch and a low-cost iPad, not to mention a bunch of announcements tied to its new services, Apple TV Plus and Apple Arcade. Most analysts like the Apple TV Plus subscription price of about $5 a month, making it competitive to other streaming companies like Netflix and Disney. But as always, all eyes were focused on the freshest versions of the iPhone.
This is the iPhone 11 Pro, and these are the most powerful and most advanced iPhones that we have ever built in a stunning new design.
Apple unveiled the iPhone 11, iPhone 11 Pro, and the iPhone 11 Pro Max. The iPhone 11 is $50 cheaper than the iPhone XR, coming in at $700. The iPhone 11 Pro price will still hit that same $1,000 mark as the XS. IDC Program Vice President Brian Reith and Bloomberg's Mark Gurman join me to discuss.
This was, another Apple event, but nothing really earth-shattering today, right? I mean, it's been a while since Apple has come out with an entirely new hardware product that changed the game. The most surprising thing today was really around pricing of TV Plus, Apple Arcade, the $50 price reduction on the iPhone 11, as you mentioned. But in terms of hardware functionality, nothing really to write home about.
Ryan, let me bring you in here. Talk to me about the iPhone, because as we know, it still makes up a decent amount of top line for the company. What was your biggest takeaway as it comes to the iPhone?
No, I think I agree with Mark, to be honest, not to sort of beat this drum, but I think that's the storyline today. It's all about pricing, right? So on the hardware side, we start with iPhone, as Mark sort of mentioned. You've mentioned the $50 price cut from where we were with the XR. I think Apple's, to be honest, in my opinion, them leading with services partnerships that came out between Arcade and News, and then obviously getting to lower cost iPhone pricing and even watch pricing, I think just shows that they see that we pushed the threshold of the average consumer pretty high on price points, and that they've got to be cautious of that, right? Because their important thing right now is keeping the install base and making sure that it grows, which I think they're still doing a good job at that.
So Ryan, are they maxed out at a $1,000 iPhone?
So listen, I don't think we'd ever max things out, right? Because keep in mind, starting points are never actually what the highest point actually gets to, right? So we're probably talking upwards of $1,500, $1,600 with the highest configurations. But no, I think that they're going to continue to push things. But I think what they're realizing is that their audience who will actually pay that price to use those features is probably smaller than it was when their highest iPhone price was $800. So, it's sort of a changing of the times. It's not Apple only that's being affected by that. Their main competitors at the top of the market, Samsung and Huawei, are both being affected the same way. So it's sort of just a changing times, in my opinion. But I do think that we'll continue to see, price points that will sit well over $1,000 with iPhones.
So, Mark, I want to come into my terminal here at GTV Go. What we're taking a look at in white is the average sales price, which is starting to rise a little bit. But along with that, on the right-hand column, is the number of iPhones sold, which is slowly dipping down. What does that tell you about where we are in the cycle?
Yeah, it tells us that there really has been a combination here of rising prices and a decrease, and it's ironic given the invitation today, innovation, right? The changes here are really all about the camera. If you go to Apple's website about the iPhone, 11 Pro, 75% of it is about the new camera functionality. And that's what the past few years have been about. The last time we saw a real breakthrough change to the iPhone was with the iPhone X 2 years ago. We're expecting bigger changes again next year as the prices are coming down, so I think things are going to start to rebound in about 12 months from now.
Ryan, what do you make of this device no longer being an iPhone, but really a camera that basically just has some audio capabilities?
Yeah, well, I guess it's probably been more than a phone for quite some time, right? But no, it's a good question, and to be honest, I think that the features that they've introduced, some of which have met some people say that like things like night mode have met up to what Google has done and others and so forth, and that's great. I think what's important to recognize is what the average consumer actually does with their camera. And I think, to be honest, with not just for Apple but some of these others, some of the features that they're integrating, a lot of that's done through software, not just modules and number of megapixels and so forth. I don't think personally everyone's actually utilizing that to the full benefit. Having said that, everybody wants the latest and the greatest, right? So I think it's important that they continue to innovate, and clearly they're, they've been a market leader in photography, and they continue to be so.
That was IDC Program Vice President Ryan Reith and Bloomberg's Mark Gurman. Apple also debuted an always-on display that never sleeps as part of its Series 5 watch unveiling Tuesday. Beyond the screen, Apple says it continues to pursue ways to boost health, as CEO Tim Cook pointed out.
We're really excited about the impact the Research app can have. It gives us, all of us, an amazing opportunity to participate in health research that could lead to innovations to improve our health and the health of future generations.
To discuss, I spoke with Creative Strategies Principal Analyst Carolina Milanese.
I think nobody has actually thought about the always-on screen. A lot of people had complained from the get-go that that was a feature that consumers wanted, especially consumers that were trying to switch from a traditional watch to a smartwatch. But today was really about moving the envelope, if you like, on the health side, and really hearing Apple clearly that this is an area where they want to continue to develop, they want to stay for the long run, and creating a health research app speaks to that.
Is pricing at $399 competitive or expensive?
$399 is competitive, and even more competitive is the $199 price point of the first generation Apple Watch. We always get carried away and excited about the latest model, but when you look at the lineup, I think that's where it is becoming more and more obvious that Apple wants to get consumers that are part of their install base to venture into new devices. So you might be an iPhone user and have yet to find out what the value add of an Apple Watch might be. $199 price point is maybe an easier way to get you to try it than not $399.
Right, so the $199 for the 3 that they lowered today, you think that that's a good thing that the company's doing?
Absolutely. It is getting that entry level more interesting for consumers. We had a bit of an impasse on the Android side as far as Android Wear and new devices that coming to the Android ecosystem. Outside of Fitbit, which I'm sure today is going to look quite worried about that $199 price point, we haven't seen a lot of uptake on the watch form factors. There are lots of bands out there, fitness bands, but not so many watches.
Right, you mentioned Fitbit, and I was looking at that earlier as well. How concerned should other wearables be today?
I think they should be quite concerned. I think Apple Watch has become the smartwatch that the rest of the industry is looking up to, and that $199 price point is super competitive with a device that doesn't feel that you're really compromising on your experience, and that's the core part. You're not getting a device that you feel doesn't give you the key features that you want, and so why not try and see what it can do for you.
Talk to me finally, Carolina, about integrating services and doing health research. What about the future of health and Apple excites you?
Yeah, I think to me that's the next level, and it's not just something that Apple wants to do for the goodness of the human race, so to speak, as far as making us all more healthy, but it's really a good way to get people to see value from the ecosystem at a level where it impacts their lives. It's not just about entertainment, it's not about having a gadget, but it's really having a device that can make a difference in your life. And they played a video during the keynote that spoke to that, having people that have had heart arrhythmia highlighted to them by the watch, and having been able to get to the hospital on time and prevent something that would have changed their life forever. That is very, very powerful.
That was Creative Strategies Principal Analyst Carolina Milanese. Coming up, the intersection of technology and medicine was the focus of a series this week that we called Wired for Health. We'll introduce you to some of the innovators and investors who are disrupting the industry in big ways next. And it's been nearly 3 years since Microsoft and LinkedIn linked up. We'll have my exclusive interview with LinkedIn CEO Jeff Weiner next. This is Bloomberg. All this week, Bloomberg Technology explored medical technology in a series that we called Wired for Health, where we looked at how innovation plays a crucial role in sustaining health. To give you some context, 21 years ago, we saw the first robot-assisted heart bypass surgery. Today, virtually every operation in the United States uses robotics. So where will the next 20 years take us in terms of innovation and disruption? Deloitte MedTech segment leader Glenn Snyder says that by 2040, healthcare as we know it will no longer exist. He joined us Monday to discuss.
By 2040, we expect the healthcare system to be fundamentally different than it is today. It's going to be one where the consumer really manages their own healthcare and controls their own data. And it's going to be a system that focuses much more on prevention and wellness than acute intervention. And also that businesses are going to take on very different roles than they have in the past.
So from your research note, my takeaway was the consumer is taking the power back. I have wearable devices. I have power over my data. What's the technology that's driving that?
Well, it's the same technology that's driving a lot of consumer-driven control nowadays. So we all shop online. We control our shopping experience, our banking experience. Consumers want to be able to control their healthcare experiences too. And so with that, it's a combination of sensors, pervasive sensors that are going to be in us, around us, measuring our health and all of the environmental data, and then radically interoperable data, which means that we're basically going to be able to combine all that data and draw some insights from it and present that back in a consumer-friendly manner.
You talk about no more silos between biotech, big pharma, venture capital, healthcare companies. How do you see all of those starting to come and work together?
Well, there's a lot of collaboration. In fact, a recent study that we did, research study, said that 80% of medtech companies expect to be doing substantial collaboration over the next few years. And so that's going to be par for the course. Collaborations within the industry as well as collaborations with some of the high-tech players, for instance, who are bringing great capabilities around AI and data analysis that are crucial for this next wave of healthcare.
So talk to me about AI. It's a big buzzword. I know a lot of people are waiting on 5G to help power some of the AI. Is that really the future?
Well, AI, let's put it this way. Today, there are over 250,000 clinical studies that occur in a year. And any physician or any individual can't absorb all that information. So the beauty of AI is that it can digest all of that data and make some sense out of it. So many times our health is a function of subtle correlations and a bunch of different biomarkers and environmental factors, and AI can pick up on that.
On this program, every day it comes up about data privacy. In your world, what is the balance between big data and more data is good versus the chance then we're all going to get hacked?
Well, I think the key is that people need to be able to control and give permission as to what they want to give third parties to analyze, right? So there's great benefit to society and to us as individuals to have companies that can analyze all this data, but we need to know what's being done, who has it, and how they control it.
That was Deloitte MedTech segment leader Glenn Snyder. If the future of healthcare is disrupted by medical technology, investment will evolve as well. ARK Investment Management has identified 5 tech-enabled disruptive platforms that should generate more than $50 trillion in business value and wealth creation over the next 10 to 15 years. They are industrial innovation, genomics revolution, next generation internet, fintech innovation, and mobility as a service. ARK Invest CEO Kathy Wood joined me Monday to discuss areas ripe for investment.
Well, of the five, we think the most underestimated today is DNA sequencing. It's really the topic you're exploring here today, Taylor. DNA sequencing is exploding, and we think if Illumina, which is responsible for 95% of all the DNA sequenced around the world, including China today, that if it re-engages in terms of cutting the cost and price well below $1,000 per human genome, that we're going to see explosive unit growth. We think that if Illumina were to be cutting costs at the rate we believe the technology will enable, 40% per year. Think about that. Healthcare, a declining cost curve, 40% per year. That the number of whole human genomes that will be sequenced will move from 2.4 million globally last year, and that's half of all the whole human genomes ever sequenced in the history of all time, to 100 million in 5 years, when we believe the price will be as low as $100 per genome. So we're going to be, yes?
Yeah, and that is a fascinating statistic, and I'm so glad that you brought that up. How important is that statistic for you as an investor, and let's say me as a consumer, getting that under $100?
We think it's very important if we are going to start analyzing each human genome in terms of mutations. So our body is comprised, or a genome is comprised of 3 billion lines of code, effectively. And a mutation is like a programming error. And it is the earliest manifestation of disease. It can start when we're born. It may not be full-blown until we're adults. Wouldn't it be nice for our genetic counselors, and that is a new job that is developing some momentum here, to identify our mutations from one exam to the next, and to identify cancer in stage 1. That is the promise of DNA sequencing costs dropping to $100 and even lower with time, and the information explosion we're going to be able to take advantage of.
So, Kathy, we fold this into your world of investing, and you have a genomics ETF, ARKG. We had a great graphic showing a list of some of your top 5 holdings. How do you, or what do you see within these companies to allow you to take advantage of that next revolution that you're talking about?
Well, Illumina, of course, is the category killer in terms of DNA sequencing, and it's foundational to everything else that we believe needs to happen. Invitae is one of the most important molecular diagnostic testing companies. It is driving down costs. Its cost of goods sold in 2013 were $1,300 per test. It's gotten that down to $250 and offers it commercially or the test commercially for $450 to $500. What we're seeing Invitae do now is very interesting. They are offering tests free to discover pancreatic cancer or Huntington's disease or epilepsy, more about those diseases. And what is happening is pharma companies, so Glenn talked about collaboration, pharma companies are paying Invitae to deliver those free tests so that they can get the information anonymized and learn more about these diseases so that they can find cures for these very difficult diseases. So lots of collaboration among pharma, biotech, molecular diagnostic testing companies, DNA sequencing, and so forth.
Kathy, within ETFs, I think a lot of retail investor interest. Who are your investors? Have you seen it within retail, or do you get a lot of institutional interest as well in this?
We believe that, well, it's across the board, and we manage funds across the board. So we have many retail investors. They really helped us start out that fund. And now we have institutional investors moving into our ETFs. It's very interesting to watch sovereign wealth funds who are trying to learn more about the healthcare systems and healthcare breakthroughs so that they can improve lives shares for their own countries, they are even moving into our ETFs because they can treat our ETF like a stock, and it doesn't have to go through a lot of due diligence and go to the chief investment officer. These are younger advisors who are actually very excited about what we're doing.
That was ARK Invest CEO Kathy Wood. Still ahead, LinkedIn is one of the few social media companies operating in mainland China. We discuss the company's operations in the world's second largest economy amid U.S.-China trade tensions. Next, my exclusive interview with the CEO, Jeff Weiner. This is Bloomberg. It's been just over 3 years since Microsoft announced its intention to buy LinkedIn. It became a reality a few months later and more than $26 billion later. The job listing site says it boasts 20 million openings and around 100 million applications each month. And unlike Facebook, Twitter, or YouTube, LinkedIn is one U.S. tech company that does operate in mainland China. I spoke exclusively to the company's CEO, Jeff Weiner, on Monday and asked him about doing business in China.
It's still early days for us in China. I think the fact, if by operating in China, you mean how we've been so successful, our vision is to create economic opportunity for every member of the global workforce. And I think other companies who have a different sense of purpose or different mission or overarching objectives have probably found it difficult to do business in China because it's inconsistent with what it is that they're trying to deliver, what it is they're trying to accomplish. Whereas the creation of economic opportunity is something essentially every country in the world can get behind. And so our operation in China is still very early days. We have a talented team in place. We have greater focus there in terms of local development than we do in other markets around the world, trying to understand product market fit, trying to understand the cultural differences, and we're going to continue to invest.
With the trade and tariffs, do you feel any more pushback being a U.S. tech company over in China?
Not with regard to the nature of our business. I think for a company like Microsoft, for some of the larger technology companies, there's different implications. But by virtue of the fact that we're a professional network, the tariffs aren't impacting us to the same extent.
There's been a lot of talk that China maybe wouldn't hurt any tech company on trade or tariffs, but set up more red tape, more rules, more boundaries, more limits, and that would be perhaps maybe their way of putting more backlash on U.S. tech companies. Do you feel any of that?
I don't know that that's anything new per se. I think when you make the decision to operate in China, it's important that you're prepared to comply with the law in China in a whole host of different ways, whether that's new regulation, whether that's additional friction, whether or not it's things beyond the regulatory purview. The competitive landscape in China is incredibly intense. We continue to see that. Operating there is very different than, say, operating in the United States, and that's part of our commitment to being in business in China.
In the last few weeks, we've seen more and more probes, investigations into big tech over monopoly, data privacy. How have you managed to stay out of those headlines?
Yeah, it certainly didn't start now for us. We made a commitment roughly a decade ago in terms of putting our members first, which is arguably our most important value, codified value, maintaining the trust of our members. Without that trust, our ecosystem really doesn't exist, the business doesn't exist. And we put together some first principles with regard to how we were going to leverage data, dating back about 10 years. And those first principles were all about clarity, consistency, and control. And as a result of not just talking about that, but walking the walk and codifying that very early on in terms of how we prioritized, how we developed strategies, how we executed, where we would make changes, that has served our members very well, and that ultimately served the company very well.
That was LinkedIn CEO Jeff Weiner. That does it for this edition of Best of Bloomberg Technology. We'll bring you the latest in tech throughout the week. Tune in each day at 5 p.m. New York, 2 p.m. in San Francisco. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.